Hi everybody. Today we want to talk about Canadians working remotely for US companies. Working from home with a laptop has become quite common. Canadian residents earn income from US employers sometimes, and when they do this, they have to navigate both Canada and US rules. In general, if you live in Canada and you work for a US company, Canada will tax that income as foreign employment income. Canadians must report their US sourced wages on their Canadian return, converted to Canadian dollars, of course. And under US rules, that income is considered foreign source. It's services performed outside the US. That income is not subject to US income tax. In practice, the Canadian worker typically has to furnish a Form W-8-BEN to the US employer to certify their foreign status and their treaty claims, so that no U.S. withholding is done. But the Canadian taxpayer needs to pay Canada Pension Plan, employment insurance, and income tax on that full amount, unless if you use a special certificate or a waiver. In short, the Canadian tax, so all worldwide income is taxable in Canada. The CRA, the Canada Revenue Agency's rules require reporting foreign employment income separately on a separate line. And the Canadian tax credit rules allow relief if any U.S. tax is withheld or paid. But normally, the way I lay this out, you would not be paying any U.S. tax. Per IRS's policies in the U.S., a non-resident alien's wages for work done outside the U.S. are not subject to income tax or withholdings, providing that W-8-BEN form to the U.S. payer documents your status and prevents the U.S. withholding. Now, Canada treats foreign payroll similar to domestic payroll. The U.S., so just starting at the front, a U.S. employer would typically be required to withhold Canadian income tax and CPP and EI on salaries paid to employees working in Canada. Practically speaking, this is not usually something that a U.S. company wants to do. They don't want to get registered with the Canada Revenue Agency, usually having to register with a province incorporations or business board, get a business number, get a Canadian payroll system, all that stuff. So practically speaking, most US employers get around this by classifying their Canadian remote workers as independent contractors. So since the Canadian is now an independent contractor, the Canadian still has to provide the W-8-BEN, but then he or she has to pay personal income tax and CPP on their income on their Canadian tax return, reporting as a self-employed independent contractor business. The other thing just to quickly mention is that there is besides the Canada-USA tax treaty, there's a USA-Canada totalization agreement that stipulates that only one country's social security applies, which does away with the requirement for this Canadian worker to have to pay anything to U.S. social security. The Canadian working in Canada is covered by the Canada Pension Plan. Now, there are some other scenarios. If a Canadian travels to the U.S. and works in the U.S. for a U.S. company, then the tax picture flips. This income is now for services performed in the U.S. It's U.S. source and it's taxable by the U.S. government. The Canada Tax Treaty has just some really narrow exemptions. For example, if a Canadian travels to the U.S., but for a non-U.S. employer, and there's no permanent establishment in the U.S. So, for example, a Canadian resident who travels to the U.S. to do some contract work for his Canadian employer, less than 183 days, no permanent establishment in the U.S., they would be exempt from that sort of thing. Otherwise, you're in the U.S. for more than 183 days, that Canadian worker must file a U.S. tax return for that income. Now, Canada still taxes its residents on worldwide income, so the Canadian will report the U.S. income on their Canadian return, but then claim a foreign tax credit for the U.S. tax paid. Some technical issues on this. The USA-Canada tax treaty says income is exempt if less than 183 days are in the U.S., paid by a non-U.S. resident and not born with the U.S. permanent establishment. if the Canadian stays in the U.S. long enough, they become a U.S. tax resident, and that actually opens them all up to reporting worldwide income to the IRS. In some cases, that makes them dual residents, which means you have to get resolved by the treaty's tiebreaker rules. And there again, a Canadian employed in the U.S. would normally pay into the U.S. Social Security. Now, you can apply for a Canadian certificate to indicate that this income is being covered by CPP, so you can get this CPT 56 form from the CRA, which certifies that yes, you're going to contribute to Canada Pension Plan on this income, and then you can be exempt from paying Social Security. Some issues about contractors versus employees. Assuming that the Canadian is engaged as a contractor rather than an employee, the U.S. tax treatment can differ here. So, U.S. company normally pays their contractor a gross amount with no, well, there is a 30% tax withholding if there's no treaties at all, but there is a treaty between Canada and the U.S. So the Canadian needs to provide their form and certify their foreign tax status and claim their treaty benefits. And you should be good to go there. The U.S. taxpayer does not need to, or the U.S. company does not need to issue a Form 1099 to the non-resident. Some people might ask about the Form 1042S, if you've heard of that one, but that is only if there are withholdings on the payment. And the way we laid it out, you would normally not have these withholdings. Some other just key issues that are starting to crop up around this area. So the CRA just put out a payroll policy saying that a full-time Canadian remote worker is typically considered attached to their employer's home office for deduction. So, for example, inside provinces, so a Saskatchewan worker working remotely for Manitoba is typically, that's subject to Manitoba tax. So the payroll thing, or subject to Manitoba payroll rules. So just at face value, that would seem to suggest that a U.S. employer would need a Canadian payroll account anyways, which we already talked about that, getting around that by calling the employer a self-employed contractor. The other thing is, if a U.S. company has an office in Canada, that could create a permanent establishment under Article 5 of the USA-Canada Tax Treaty, which would then make that company or that corporation have to file a Canadian corporate tax return for any Canadian activities. Now, under the tax courts, they've decided that simple just telework by itself, remote work by itself, does not create this permanent establishment, unless if the worker is at a certain level of authority. For example, has the authority to sign contracts on behalf of the company, or is doing activities other than just telework, like manufacturing or assembling product for sale, for example. Yeah, so for Canadian workers and small employers alike, the simplest approach is clear communication and proper classification. Many U.S. startups will find it easiest to engage Canadians as independent contractors using that W8BEN to avoid the Canadian payroll system. Workers should keep careful records of days spent in each country to track your residency status and your treaty eligibility, because there are things that rely on specific amounts of days. And finally, if you've got more questions, you consult a cross-border tax advisor. You can leave a comment in the video. Thank you so much.